What is going on today, YouTube? I hope you guys all had a great day. And today I'm going to talk to you about investing versus paying off debt. If you're new to my channel, I make daily stock market videos. If you like this kind of content, subscribe to my channel, leave a like on the video, and comment below. So today, to get right into it. So should you invest or should you pay off your debt? This depends. This depends on what kind of debt you have. It all depends on the interest rates you're paying on that debt. I'll show you why in a second. But I'm sure you all know, you can look up, you're going to make about, now if you're just investing and you're planning on getting returns, like the stock, like average returns are about 9.5% per year. It's an average return. If you're just trying to get that, then figure on 9.5%. That's what we're going to use for this video. Now I know you can trade, day trade, you can swing trade, whatever, and have a higher return on your investment, but this is just for the investor that's banking on making 9.5% per year. So we're going to switch over to a little program on numbers. If you have numbers, if you use a MacBook, anyone can get this. All it is loan comparison table. Why this is important. Okay, I'm just going to show you for instance. So you have a school loan, a credit card, and a mortgage. $30,000, $15,000, $30,000. Say you have $15,000 on that credit card. And you're paying 15% interest. Right there. You already know. You're paying 15% interest on that. You're only expecting a 9% return at most out of the stock market. So right there, you're losing 6%. So all you gotta do is look at the interest you're paying on your debt and look at the interest that you're planning on getting in the stock market. Here you have a 6% loan, a 15%, and a 6%. Get the average of that, that comes out to 9%. So this is just on a 5-year basis, and if you're paying 9% on your loans and you're only expecting to get 9% back out of the stock market, you should not be investing. You're losing out on money. All you're doing is equaling out your debt interest. See right here? Down here in this chart, this little table. You have your original principal, and this is what amount of interest you're going to pay back in 5 years. So you're going to pay back almost half of your credit card debt in 5 years at 15% interest. You're just wasting that money. That's money wasted. Say you have $15,000, you figure out how to pay it off in a year. Look at that money you save. That went the whole way down to $1,246, and it was at $6,411. So you're saving about $5,000 that you can use to invest once that's paid off. And yeah, I know it sucks because you're just paying off something that's hanging over your head instead of putting your money into something that's going to grow, but that's going to help you in the long run. You pay that off quicker. Instead of paying that monthly payment of $357, I know this is very high for an example, but instead of paying that $357, say you double up on payments. So you cut this in half. You get in 30 months. You're still saving half that interest. You're cutting that interest in half. You're going to get that paid off faster, and then think about it. That credit card's, say that's gone. That debt's gone. That's $603. You can just put it straight into your investments. Don't even put it in your bank account and spend it and go to debt again. Either put that straight into your investments if you want to start investing that bad, or use it as like a snowball effect and use it so you start paying down these other payments. Put 600, you can double up on that then. So we're going to say that's down to 30 months now. If you double up on that, that's going to change that 30 months into a 15. So I'll be cutting half to 45. Look how much you save there. And then if you put both of these into this payment, you're going to be paying $600, $1,200, $1,300, about 3 times as much. So that's going to cut that down 3 times. And you'll probably cut that down into, say, 52 months. That's where you start saving your money, and that's where your extra money. Then when you're done paying off all this debt, your money's going to go into your investments, and that's when it's going to really start growing. But if you're investing while you're paying these ridiculously high interest payments of like 15% and 6%, that's just a way of wasting your money. You need to get these. If you have a loan that's only, say, you have a loan that's at 3%, it's actually good to have a loan. 3% interest, look at that. You're only paying an extra $1,757 in 45 months. We'll even change it to 5 years. Paying an extra $2,300, but now that other 6%, you're making a plus 6%. Say those 2 other loans are gone now, and you only have a 3% loan left. All that extra money that you were using to pay off those loans, put into your investments. And now if you're only going to get a 9% return on the stock market, you are still plus 6% on your returns. That's where all you need to do is look at this annual percentage rate. And if this is higher than your expected 9% return in the stock market, pay this off because you are losing out on money. And if this is lower, if it's a manageable fee, and it's always good to have a loan, it helps your credit score and everything else. So if this is manageable, it's small enough, you can see you're not paying that much interest. But if you're the kind of person who just wants rid of it, pay this off, and then once this is paid off, start investing. But the money you're using to pay off this loan, just don't start spending it. You need to put it into investments, and then your investments will start skyrocketing. So that's it for the video, guys. Just take away. If your interest rates that you're paying are higher than your anticipated percentage returns off your investment in the stock market, pay off your debt. If they're lower and it's manageable and you like the margin, then put more into investments, because investments they don't have to be at 9%. They can be lower, they can be higher. So yes, if you have a great year in the stock market, you could get 30% return in a year, and that's going to crush no matter what interest rate you have, but you don't know what's going to happen. It's all a mystery. This is known. You know you're going to have that percentage rate. If you think that's going to get close to your anticipated return in the stock market, pay this off. So if you liked the video, guys, and this helped you out, leave a like on it, comment below if you have any questions, and share it to someone else that could use it. And if you like this kind of content, subscribe to my channel, and I will see you guys tomorrow.